Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we're talking about mastering trend lines and moving averages. So a trend line is the same thing as the horizontal support resistance lines that we had drawn. It comes from the same menu. There was your horizontal lines. This is the top one on the menu, and they are drawn very easily. Click one spot, drag to another, click it again. There's your trend line. The idea behind a trend line is it is where buyers and sellers are coming into the market. So for example, take a look at that. This is the Qs, and this goes back 2 years. Every time we touch this trend line, we bounce. So traders will use it as an entry tool. Sometimes they'll use it as a tool to add to an already existing position. And they quite often will use it as a tool to determine when the trend is over. Notice how we had bounced from this line. We broke through it, entering a downtrend, retested it, just like you do horizontal support resistance, and then finally broke down. The higher the time frame, the more relevant the trend line is. So, for example, let's do dollar Canadian dollar. And let's go down to the 30-minute chart. This trend line had started. It offered resistance. Now, you want to see at least 3 candlesticks hit it. There's multiple ones there, multiple ones there, multiple ones there. But notice how it did get broken through relatively quickly. And that makes sense if you think about it, because it takes less effort to make that trend line as opposed to, like, say, over 2 years, like we saw on the Qs. So the idea is once you break through one, and a lot of times people wait for a candlestick close above or below it to determine whether or not it's holding or it's being broken out of. So like in an uptrend, let's do some crypto here. And an uptrend like Solana, let's just say on a 4-hour chart, we're in an uptrend for a while. Things are looking a little better. We finally break through it. Well, once you break through that trend line, you know that the trend is changing. Just like you could have made an argument for a downtrend line here. Touch, 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 broke above there, came back, retested it, and then took off to the upside. So it works the same way as the horizontal lines do. The other thing that you can do is use moving averages. So you come up here to the indicators, click on this, and you type in. Now we happen to have them moving average exponential, but you can type in moving average, and then there's a bunch of different types, but we click on moving average exponential, and you can see it pops up there. I click it again, and I click it again. You can add multiple ones. There is an eyeball where you can hide it. So let's go ahead and hide for now. Let's switch to currencies. They do tend to be a little bit more stable. Not always, but they do tend to be. So this is a New Zealand dollar. We remove the drawings here. This is a nice uptrend line on the 4-hour chart for some time. But again, we're still very much in a downtrend. So you could look at the downtrend line that is forming right there. So you could say that you would expect to see some selling pressure in that area, right? Well, let's go ahead and show some moving averages. Let's click on the wheel for the settings. And this is the 9. So what the 9 moving average shows is a line, as you can see, that follows right along with price. Now, what this is would be a representation, like right here at this part is a representation of the average price, in this case of the last 9 candlesticks. Now, it's an exponential moving average, so it's not a pure average, it places a little bit more weight on the um, calculation for the last couple of candlesticks. It just makes it move a little quicker. So let's go ahead and change this to the 20. So this would just be 20 candlesticks. And notice how it shifts. It smooths out quite a bit, and it tells you that the average price is dropping. So you're in a downtrend, at least for the last 24-hour candlesticks. We go to the daily, you can see it's much smoother. The 20 just started to turn higher, so it shows that the average of the last 20 candlesticks is rising. Go ahead and change this to 50. Now, 50 and 200 are kind of standards that people use a lot. And the reason being is it goes back to the old Wall Street days, roughly 50 trading days in a quarter and 200 in a year. You can see that it's much slower to react. And a lot of times what you see is the 50 with the 200. So let's make the 200, actually let's make the 200 blue. Let's make the 50 red because it's quicker. So there's the 50. And let me release the blue. And you can see how the longer term trend is definitely to the downside as well, although the 50 is starting to turn higher. They quite often are used as dynamic support and resistance, not always. And it's just a general guideline. Really can be sloppy, do horrible job in consolidating markets. But one of the things that moving averages going sideways can do is tell you when things are going sideways, which means that you should be looking at consolidation. So people will use them to identify trends and potential dynamic, in this case, like resistance. You can see it has offered resistance on the way down. Let's go ahead and switch over to crypto, Bitcoin, kind of the same thing here. Some indicators, some moving averages, numbers and stuff work better with some markets, and that's a bit of an experiment. But you can see like this particular market here, Bitcoin's very heavily retail driven at that point. So they were all following the 50-day EMA. Same thing over here on the way back down. With that, it does make a lot of sense in that particular market. But when you get, the stock market, like the 200 seems to be important. The 50-day EMA, not as much. So the 200, a lot of times people will just say, well, we're above the 200, so therefore we're in an uptrend. On this Apple chart, you could have taken this and gone right along with this trend line. You can see everything's holding as great support. Notice that the 50-day EMA crashed below the 200-day EMA shortly after the breakdown. That's a bad sign. Doesn't mean anything has to happen, but it does suggest that perhaps the momentum's dropping. It's actually what is known as a death cross. When the 50-day EMA drops below the 200-day EMA, it suggests that you could be entering a bear market. The opposite is true. When the 50 breaks above the 200, it could be a bull market. That's what is known as a golden cross. And you can see clearly that was the case from 19 to 22, 2019 to 2022. The idea being the 50-day EMA is shorter term momentum. So if it is breaking above the slower momentum, the 200-day, then that means we're starting to see an impulse to the upside, or of course, vice versa. Moving averages are a tool. That's all they are. It's difficult to trade based solely upon them, but you will see plenty of examples of me looking at a chart with a pattern with moving averages going forward. I just kind of wanted to give you a quick overview of what they are so you know what I'm talking about. In the next video, we'll start talking about momentum indicators, such as RSI, MACD, looking at overbought and oversold conditions.